How much of your house is tax-free when you sell it? Have you ever thought about that? If you were thinking about selling your house, or maybe you already did, and you're wondering, how much of the gain do I have to pay tax on? We're going to talk about that in today's show. If you are new here to the channel, or if you're new to the podcast and you're listening to it that way, my name is Chris Hammond, financial advisor at Hammond Wealth Advisory, where we help our clients prepare for retirement and even into retirement. Make sure things like they have enough income coming in from Social Security and a pension if they have it, or withdrawals from their portfolio. Make sure that their investments are aligned to meeting their goals. Make sure they have a second set of eyes that looks over their tax returns that they file every year to help them minimize those costs over the long term as well. The ultimate goal being that we want to help preserve people's portfolios and their wealth for their whole retirement, so they don't ever have to be wondering, am I going to run out of money in retirement? It's a really important thing that people want to make sure that they are safe on that. Now, taxes are going to be one of the biggest expenses that anyone is going to pay in retirement, especially with people having the bulk of their money is usually in something like a 401k. They have to pull money from it. They have to pay tax on it. But today we're going to be talking about taxes on the sale of probably your biggest asset outside of a 401k that you'll ever own, and that is your home. So let's jump into this. So let's start out with why this is important. It's important because your accountant could possibly miss this when you're filing taxes if you sell your home, and it could cost you thousands. I know an example just recently of a couple who sold their home. They had a gain on it, but the accountant thought that it was had always been rental property, and he had checked a certain box. And when he saw that they had sold it and had a gain, they ended up having to pay some additional taxes, approximately $20,000. And it wasn't until somebody else that they were talking to was telling them about, well, you shouldn't have to pay taxes on the sale of a house that you lived in if it met the requirements, that they realized what had happened. They filed an amendment to their tax return, and it saved them approximately $20,000. That's a lot of money. Okay. So that's why this is really important. And sometimes these things fall through the crack. We're all under a deadline to file our taxes by April 15th. And that means our accountants, they are also under the deadline, and they have a lot of stress on them to do this. And they may have hundreds of clients that the accountant, he or she, is serving, and they got to make sure that they treat those clients right and get those taxes filed at the right time so that the taxpayers are not penalized. Right. Well, that time crunch can create certain things that sometimes things can fall through the cracks. All right. So we don't want that to happen with you. That's why this is so important. So let's jump in and talk a little bit about what this is. To be able to exclude some of the gain on the sale of your house, this is a thing called the Section 121 exclusion. Now, in a nutshell, if you're married, you can exclude up to $500,000 of the gain. And if you're single, you can exclude up to $250,000 of the gain. So let's just talk a little bit about what is a gain. Well, a gain is the increase from what you bought the house at. So let's just go over an example. If you're watching this on YouTube, I've put this up on the screen. Let's say you bought a home for $300,000. Then you sold it for $500,000. The gain was $200,000. So that's the $200,000 of, can I exclude this from having to pay tax on that $200,000? Now, there's other things that could affect what the gain is. Let's say you had to pay real estate commission fees out of the sale of your house. Well, you get to exclude that, and essentially lowering what the gain actually is that you had on the house. Or on the flip side, let's say you bought the home for $300,000, and let's say you installed renovated and put in a new kitchen, and it cost you $50,000 to do that. So instead of saying you bought the home for $300,000, you could say you've got $350 in that home, and therefore when you sold it for $500, the gain was only $150. So there's some things that can be that can work on both sides of that equation when calculating what the gain is. Now, how are gains taxed? Well, in this country, we have capital gains tax, and we're just going to talk about long-term capital gains. It can either be 0%, 15%, to 20%. So if you have a $200,000 gain on a capital asset and you have to pay a 15% tax on that, that's going to be, I believe, if I'm doing the math correct in my head, $30,000 for that. All right. So that's how capital gains, whatever capital gains tax rate you fall in, that's how it's going to be taxed on that. So if you can exclude that from the sale of a primary residence, that's a wonderful thing. Now, some points to consider. The tax exclusion only applies to your personal residence. So if you had a rental property, you bought it as a rental, you've rented it out for all these years, and you're going to sell it, and you never lived in it at any point during that time, and you sell it, that does not qualify for the exclusion to the gains. In other words, you have a gain on that, you're going to have to pay the capital gains tax on what the gain was from what your basis was in that. Next thing is determining what your primary residence is. So if you have, let's say, your regular home and you have a vacation home and you split your time between the two, the one that you live at the most is going to be your primary residence. Let's say, just for fun, that you had a 50-50 split of the time that you spent at each house. Then they're going to start looking, there's going to have to be some other factors that come into play to paint the picture of which one is your primary residence. All right. So it's the primary one that counts for the exclusion. Now, this means it could be your house. If you had a condo, it could be that. That applies also to a condo. It could even be a houseboat. I don't know how much gain you can have on a houseboat, because boats are typically a depreciating asset that don't really go up in value so much, but I'm not in that world. Maybe they do, right? Could be a houseboat, could be a mobile home. Mobile homes, they don't really go up much in value either. They're kind of a depreciating asset over time, but they would still qualify for this exclusion as well. And another point to consider is that Section 1031 property does not qualify. So what's Section 1031 property? All right, let me give you an example. Let's say you bought a rental home 20 years ago. You've owned that home, and you owned the home for 10 years. You sold it. You had a gain on it. You would have had to pay tax on that gain, but you did this thing called a Section 1031 exchange, and you bought another rental property. So let's say you had a $50,000 gain on the sale of that first rental, and you were able, within the time frame allowed, buy another rental, and the IRS lets you to defer, where you don't have to pay tax on that gain right away. Now it's inside that new rental home that you have. And then let's say later on down the road, you decide to move into that new rental home. You say, I'm done being a landlord. I want to live in this home myself. And then you decide to later on sell that primary residence of yours that had that 1031 exchange deferred gain in it. That property would not qualify for this exclusion as well. So that's kind of, not a lot of people are going to fall into that, but it's worth noting that. Now, here's where the meat of it. You really need to be thinking about this. There's two tests that you have to meet in order to qualify for this exclusion on the gain. The first is the ownership test, which means you need to have owned the property at least 24 months out of the last 5 years up to the date of the sale. If you're married, only one of the spouses, only one of you needs to meet this test. So have you owned the home 24 months? That's 2 years out of the last 5 years. That's the ownership test. That's the first one. And the use test is similar to that. It says, did you use the property as a primary residence at least 24 months out of the last 5 years up to the date of sale? And both spouses need to meet this test. So going back to the example I mentioned earlier, the couple, this is a real life example. The couple had owned this property, this house. It was their primary residence for 10 plus years, and they moved into a new residence, but they didn't sell the first one right away. They rented it out for a year, right? Didn't have any of the Section 1031 rental exchange stuff, any of that going on. They just rented it out for a year and then sold it. Well, they had owned the property for 24 months out of the last 5 years. They had lived in it as their primary residence for 24 months out of the last 5 years. Even though they rented it out for 1 year after they moved out, they still qualify for the exclusion. And this is that example where it's real easy for an accountant, if they're under a time crunch, to say, oh, this is a rental property. I see you had rental income from this last year. You sold it. and they just assume that you have to pay the tax on the gain, right? So that's what's going on there. So these are the two tests that you need to be thinking about if you're thinking about selling your home and you're thinking about how much of it would be tax free, that you would not to pay tax on. Now, last point to consider is you can only use this exclusion once every 2 years. So if you have the house you live in now and a vacation home and you sell your primary residence and you have a big gain and you get to exclude it, don't pay any tax on it, you can't turn around and do that same thing the next year with what used to be your vacation home that you now turned into your primary residence. You can only use this once every 2 years. And if you really just want to geek out on this stuff, you can dive into it farther with IRS publication 523. It goes into all the details about that, how that works. And just so you know, the tax code can be a little dry, but if you wanted to jump into that, that's where you could go and get more information. Now, you may not want to dive any deeper into this. You may be in a situation where you've been looking all over the internet, trying to figure out things about getting ready for retirement, things about taxes in retirement, stuff like that. And maybe you're at the point where you're thinking, I might possibly want outside help with this, outside help with not only having a second set of eyes looking over tax returns or things like that, but also looking at making sure I've got all my ducks in a row before I actually do retire, that I've got things set up that when I do retire, I'm managing my 401k the right way. And I want to make sure I'm managing it the correct way for this new phase of life that I'm about to enter into, where my paycheck has gone away and now I'm living off fixed income, Social Security. And I want to make sure my portfolio is going to be invested properly, the correct way to last me the rest of my life. Well, if you're in a situation like that, one thing that could help you out tremendously is to go to my website, retirementplanningmadeeasy.com, and just go there and download a free copy of my essential step-by-step retirement guide. Now, it's going to give you a good example in there of cash flow planning. Now, that's going to be really important to you if you're getting close to retirement and your paycheck is about to go away, and now you're on just Social Security. Maybe you have a pension, but maybe it's not enough to cover everything. This is a good exercise that you can do with even fill in the blanks, where you can put your information in, customize it to help you to understand how your income is going to look like in retirement, and get you thinking about those type of things. And if you need additional outside help, when I send you this report, I'll include some links in there if you want to take advantage of just hopping on to my calendar and having a quick chat with me, and then we can talk a little bit about if we'd be able to help you out further with making sure everything is looking good for your retirement. All right, that's all I've got for today, and we'll wrap this up. Thank you for spending your time watching this, or if you're listening on the podcast, thank you for being here, and I'll see you guys on the next episode. Have a good one.